You open an account statement and see smooth gains month after month. The market goes red, but your line only climbs. If it looks too steady to be true, it probably is. Stay with me, because by the end, you'll know how the biggest Ponzi scheme in history fooled banks, funds, and regulators. And the simple questions that could have stopped it sooner. 1990s, 2000s, New York. Bernie Madoff Investment Securities looks like a fortress of credibility. A former NASDAQ chair, a respected market maker, a name everyone recognizes. Reputation is the first layer of the disguise. The pitch is calm, not flashy. A split-strike conversion options strategy that hedges risk and delivers modest, consistent returns. No wild promises, just 10–12% a year, like clockwork. That clock was the loudest red flag. Feeder funds gather money from clients and send it to Madoff's advisory business. Layers of distance dampen skepticism. Investors see a famous name on the envelope and a steady line on the chart. Diligence turns into trust, and trust turns into habit. On paper, trades happen at perfect prices. Fills appear after the fact as if time ran backward. Volumes don't match what the market could have absorbed. A quiet impossibility repeats across statements. 1999, a derivatives analyst named Markopolos looks at the strategy and does the math. He tells the SEC the world's largest hedge fund is a fraud. He submits multiple memos over years, laying out testable red flags. But oversight gets split by offices, limited by experience and slowed by process. Meetings happen, files open and then close. The scheme survives another market cycle. Illusion outpaces investigation. Here's how the engine really ran. New money paid old returns. Withdrawals were funded by fresh deposits. There were no real hedges on the scale claimed, just paper trades created to match the story. The consistency was the tell. Up in up markets, up in down markets, up in flat markets. No drawdowns like similar strategies. No volatility that real options desks live with every day. A line that's smooth is not the market. It's a pen. Behind the scenes, a tiny accounting firm signs the audits. Not a big four, not even mid-tier, just a small practice few had heard of. And the custodian, the keeper of client assets, is Madoff himself. The referee and the player share the same jersey. 2008 arrives like a stress test you can't fake. Markets dive, redemptions spike, and the tide rolls out fast. Feeder funds ask for billions back at once. The money isn't there. December 10th, 2008, Madoff tells his sons the advisory business is one big lie. December 11th, he is arrested and charged. The illusion stops, and the math has to be done for the first time. Headlines say 65 billion, but that number includes years of fake profits on statements. The real cash lost, the net loser amount, is roughly 17–20 billion, still catastrophic by any standard. A court-appointed trustee, Irving Picard, begins an unprecedented clawback effort, suing net winners who withdrew more than they put in. Over time, more than $14 billion is recovered for victims. A hard technical process turns years of paper into something closer to justice. June 2009, Madoff pleads guilty to 11 felony counts. He is sentenced to 150 years in prison. Courts, regulators, and investors begin the long after-action report. What failed, and how do we fix it? What failed was simple and human. Familiarity bias, cozy networks, and the comfort of consistent statements. What fixes it is structure. Independent custodians, credible auditors, surprise exams, and real risk disclosure. Post-Enron and post-Madoff rules tighten. The SEC enhances custody rules for advisors. Independent verification becomes standard. Whistleblower programs expand, tips get tracked, funded, and prioritized. Fund due diligence matures. Operational checks become as important as performance numbers. The lessons fit on one page. If returns are smooth in every market, ask why. If the manager self-custodies assets, don't walk, Run. If the auditor is tiny for a massive operation, ask what you're not seeing. If strategy detail is vague and trade volumes don't match the market, trust the math, not the brochure. Markopolos' memos are a study guide. He compared reported option positions to actual exchange volumes and found they couldn't coexist. He noted the lack of an independent custodian and a tiny auditor as deal breakers. He gave regulators a checklist that now lives in every serious due diligence playbook. Why this story still matters is bigger than finance. It's about verification over reputation, about how systems learn, slowly, sometimes painfully, to close gaps that charm and confidence can slip through. For families and retirees, the numbers weren't abstract. They were college funds, homes, and decades of work. For charities and foundations, they were missions paused or cancelled. The human cost sits behind every headline. If you dig further, read the SEC Inspector General's report, the trustees' recovery updates, and court filings. Separate myth from mechanism. The scheme wasn't genius, it was paperwork and timing, scaled by trust. We keep this channel respectful and ad-safe. No sensationalism, just the record and what it changed, because understanding the red flags is how we honor the people who paid the price. In the end, the Madoff story is a mirror. It asks what we believe when the line climbs too neatly. It reminds us to ask simple questions with stubborn patience, and to let the answers change our minds. If careful, fact-first storytelling is your thing, you're in the right place. Subscribe and keep watching. Next up, another case where the fine print was the whole plot, and the one document that broke it wide open.